Today, Christy and I are diving into one of the best ways to purchase property using the infinite banking concepts. In recent years, many home buyers have struggled to compete in the market. They often lose out to cash buyers. But what if you could buy properties with cash without needing to be a millionaire? That's exactly what we're going to be breaking down today. This is a conversation you don't want to miss. And if you haven't already, be sure to subscribe to this channel by hitting the notification bell so you never miss out on our latest content. Now, let's dive in. I love talking real estate. I've got a long-standing history in the real estate business, but I like to think, that in my journey, I've gone through real estate, the trials and tribulations, and I've also evolved. And now I like to say, all I do today is be the bank, and that is the ultimate in real estate. And that's kind of what I want to show your audience. I want to show them not just how the infinite banking concept can really, like you said, save them a boatload of money because, as you know, with mortgages, you're giving so much to the banks with the way amortized mortgages work. But that would actually work in your advantage if you were the bank doing that. So I want to take a little bit of time to showing folks how to best design their policies, especially designed and engineered whole life, to be used for the real estate industry.
Wow, I'm excited. So let's go.
All right. So first and foremost, I think I'm going to go to the whiteboard because that's kind of just on pace. So if somebody were to get into real estate, and let's just keep real estate really simple. I mean, real estate could go from, small real estate deals like a mobile home straight to multi-million-dollar developments. But let's just start on the lower end and mobile homes, or maybe even, a lot of folks love buying their first homes. And maybe you've heard of house hacking, which would be buying a double, like a 2-unit. You live in one side and then you rent the other side and your tenant technically pays your mortgage. So that would be kind of a unique way to look at it. But to do that, a lot of people have a dream of buying their first property cash. Now that would take saving up money. So that's how I want to do it. So most people, what they would do is they would save up money in a bank account. And then when they're ready to buy the property, they would take the money out of the bank account and then they'd buy the property. I mean, pretty simple. But what if all we did is we just changed where the savings went first? And instead of putting it in a bank, we took it out of the bank and we put it into your own banking system. We created a specially designed and engineered whole life insurance policy that would then serve your goal, which in this case is going to be real estate. And I'm going to show you some numbers in a second when I share my screen, but I just want to show you the process. We would save inside the policy, which the reasons for doing this, a lot of people are like, why would I ever do that? Well, number one, the specially designed whole life policies pay guaranteed interest. So let's just pick on one of the companies. They pay 3.25% guaranteed. It never changes. Now, I know some of you are thinking, yeah, well, my bank account's paying me more than 3.25. That's great. Until Jerome Powell and the Fed comes back on the news again in their next meeting and drops interest rates another 0.25%, then you're making less. And every time they drop, you make less. With the policies, this guaranteed interest rate is a contractual guarantee, which means it never changes. Doesn't change today, won't change next year, and won't change when you're 40 years into the contract. It will always remain the same. But the other thing that's important to understand is why we use whole life or specially designed whole life is they all pay dividends if you're dealing with mutually owned companies, which aligns the insurance company, which is mutually owned, with you, the policyholder. Technically, in a mutually owned company, you can Google this, the policyholders are owners of the mutually owned insurance company. They are directly aligned with the ethics and in the way that the company is run. And that's why they give you a dividend. A dividend is nothing more than a return of unused premiums that the insurance company collects, which is the profits at the end of the day. And these insurance companies, even the youngest, I always like to say, which is 143 years old, they have never, ever in their entire existence missed a dividend payment. So now when we're looking at this, I know some of you weren't excited about the 3.25 guarantee, but if we roll dividends, we're going to now get ourselves to 5.75%. We have companies that go up to 6.4%. So when you really start thinking about the whole life policy versus a bank account, I mean, number one, you're making a better return on your money. Number two, because it's life insurance, if it's designed properly, which we know how to do these the right way, which is makes it all tax-free. So this cash value in your policy is going to grow tax-free. In real estate, one of the biggest risks real estate investors have is liability. Someone trips and falls, somebody gets hurt in your property, they sue you. this money inside the policy is protected from judgments and liens in almost all states. Again, you can do a quick Google search with your state to see if your cash value is protected, and it will pop up and tell you, yes, it is, or not entirely. And not only that, listen, at the end of the day, your bank account is not giving a death benefit when you die. These policies all pay a death benefit when you graduate, or heck, I'm going to graduate too. We all will go on to meet our maker. And when we go on, we can leave our family in a better place. So if you had an account that you could put your savings for real estate into that pays a better guaranteed interest rate plus dividends in a tax-free environment, pay a death benefit, and be protected against judgments and liens, like, now can you see why we use this account and why the wealthiest families throughout history have used none other than specially designed whole life for their wealth? But that's all this stuff. I'm just going to erase it all. All that is just the beginning, because what we're really going to do is we're going to do the exact same thing you do every single time you've bought real estate or thought about buying real estate. We're going to be the bank. So when we take the money out of our policy, we're going to take it out as a loan. We're going to come over here, and I'm just going to kind of draw this. We're going to buy our house. Now, whatever the interest rate is, that's the going rate, let's just use 7% for today's numbers. Let's just say when you take the loan from your policy, you set up a note from you personally to your entity or whatever company is going to be buying the real estate. Because usually, if you're buying real estate, especially rentals, you're buying them in a company name. And even if you're in your personal name, you would do a note from you personally to you personally. I know that sounds silly, but listen, that's fine. It's perfectly fine. You're just committing yourself to being the bank. Now over here, you have taken the loan out and now you've bought this property. And this property is going to produce rents, or even if you're just doing a house hack where you're living in one side and your tenant is paying for the mortgage, what you're going to do is you're literally just going to take the mortgage payment, because you're going to structure a mortgage payment, and you're just going to pay it back to yourself, your policy. So I think the thing I want to talk about is how simple this is. It's the exact same thing you're doing today, except for you're becoming the bank. You are taking back the banking functions in your life. Then you're still making a mortgage payment. You're still taking your net rental and saving it. But instead of putting it in their bank, you're putting it back in the policy, which is your banking system. So you never lose any control of your money. You never lose any growth potential of your money, because that's the biggest thing. I talk to people all the time that pay cash for cars. They pay cash for everything. And I say, that's great. But when you pay cash for something, let's just talk about a property. If you took money out of a bank account that was paying 4% to buy a piece of real estate or your house, that money that you took out of the bank never can earn for you another day of your life. It literally stops earning. You lose the earning potential on the money in a bank account. But in the policy, you never lose the earning potential because your money never left. So like in this example, let's just use $110,000 and just don't get caught up in the numbers. I'm just using an example. If you had 110 and you took 100,000 out to buy this piece of real estate, you still have $110,000 in the policy earning guaranteed interest plus dividends in a tax-free environment, protected against judgments and liens, and you got yourself a death benefit so that your family's protected. All the while, you now have the property producing rents or producing a mortgage payment, which all goes back to the same place. So you can see, unlike using a bank account or traditional sources, your money never loses its earning potential. Now, that sounds good and great, but there is a science behind how you would design that specially designed whole life to best suit you when buying real estate. And that's what I want to do now. Now, not often on Christy's show have I really gone into how to design a policy. And today I want to show you this, and I want to be completely transparent, literally peel the curtain back so you understand why most financial advisors and most insurance agents will never show you what I'm about to show you. And it all comes back to a simple thing. And Christy knows this. They would make 60 to 90% less. So literally, you'd have to go to your advisor or agent and say, hey, listen, I want you to design a whole life policy for me in a way that reduces your commission by 60 to 90%. What do you say? Y'all in? They're going to be like, number one, I can't do that. They're going to try to play that card. That's not allowed. And number two, why would they want to take a reduction in pay for 60 to 90%? They can do it. It just comes to contractual design of the policy. So it's not doing anything wrong. It's not like they're rebating part of their commission, which is what they think when you tell them that. They're not. They're just designing the policy to literally pay them less and give you, the client, more cash value. Someone's got to give, so somebody else gets. So before I go into this, I'm going to pause for a second. Christy, anything that you want me to cover on the drawing or in the process before we go on?
No, that's what's so wonderful about the way you do this is it's such elementary terms that you make so much sense. So no, keep moving forward. You're doing great.
All right. So what we're going to do now, folks, is I'm just going to show you an illustration. And this is just a hypothetical illustration. But what I did is before doing this, we're going to call our client Speedy Gonzalez, just because I don't want to use anyone's real name. And this is one of the insurance companies that we work with. And I did this on a 55-year-old because, hey, listen, I oftentimes will show illustrations of someone in their 30s and they're like, well, I'm in my 50s. I can't do this. So here you go, 55 years old, and I could show this for somebody that was in their 60s. But what we're going to look at here is somebody, and again, don't get hung up on the numbers. I can illustrate it any way, but this would be somebody that had been saving up for a piece of property, and they've saved up $100,000 in some account. It doesn't matter what the account is. Could be money in a bank account, a CD, a money market. The money's been saved up. And they want to continue to keep saving because even when they buy the property with the money they've saved, they want to make extra payments on their mortgage to pay their property off in half the time or less. Now, have you ever looked at a mortgage amortization schedule and looked at how much interest you would save if you just made one extra mortgage payment? It's a lot. What if you just made extra principal payments every month on top of your normal mortgage payment and you shortened the amount of time you paid that mortgage? Look at how much interest you would save. It's in most cases, tens, if not hundreds of thousands of dollars in interest. So what we're going to do is we're going to look at doing this the same thing, except for we're never going to leak any interest. We're never going to pay the banks any interest at all. Every payment you're going to make is going to be a payment back to yourself. But if you can see from here, what we're going to do is we're going to save that $100,000 that we saved up. We're going to call that a dump in. We're going to take that $100,000 out of the bank and we're going to put it right into this specially designed and engineered whole life policy like I'm showing here. Then each year, we're going to save the equivalent of $11,000. So in the first year, this particular client, Speedy Gonzalez, would have put $111,000 into the policy. And the next year, they're going to save $11,000. Now, it doesn't matter if they do that in one deposit or they do that in monthly savings deposits. It doesn't matter how you put the money in the policy. And again, your numbers could be any number you want. But most people, they could dump money in. They can't continue to put the same amount in every year. So most folks we deal with, I mean, if they could save a little under $1,000 a month, this would be a reality for them. So let me kind of get a pen here. I want to show you some things. First off, if we put $111,000 in the policy in the first year, this policy, as you can see up here, this is the design. When we design these policies, we don't start with the death benefit like you would life insurance. So clients don't come to us and say, hey, Chris, what would it cost to buy $1 million policy? We would say, we don't know. You would come to us and you would say, hey, Chris, I was thinking about buying a piece of real estate, but I watched one of your videos and I want to know what would be the best way for me to buy real estate if I had $100,000 saved right now in my bank account and I'm willing to save roughly $11,000 a year. What we would then do is construct the policy to hold that $100,000 dump in plus $11,000 per year. Now, remember I mentioned earlier, we have to build these within the IRS rules. Otherwise, it becomes taxable like any other investment. So to be considered life insurance, what we have to do is abide by what the government, or the IRS, I should say, says the minimum death benefit needed to put $111,000 in the first year and $11,000 each year is this, $1,348,131. Now, how many of you have ever gone to your agent or your financial advisor and said, hey, can you tell me how much it would cost to buy $1,348,131 in death benefit? Never. Nobody's ever said that to their agent because it's backwards. We're building these completely backwards. But now, how is that reducing our compensation? Well, I want you to look down here on this illustration. See this point right here where the death benefit goes from 1.4 million down to 380,000. Oh my goodness, what happened, Chris? Why did the death benefit fall so much? Don't be alarmed. This is by design. You see, the reason this death benefit was so high in the first place is we used a term insurance rider. Yeah, Dave Ramsey says it all the time. He says term insurance is the cheapest insurance. Why would you ever put money in whole life? So we said, all right, well, if the IRS says we need a ton of death benefit to support that amount of deposits, well, let's use the cheap stuff. But let's only use the cheap term insurance for a period of between 7 and 10 years. Why 7 and 10 years? Well, it's simple. The IRS says we need to maintain a specific death benefit for 7 years. They call it the MEC 7-pay rule. You do not need to understand the MEC 7-pay rule. We do. When we're designing it, we need to understand that for 7 years, the IRS has a test they're going to do each year to make sure we have enough death benefit to support the amount of premium deposits going in so that this is still viewed by the IRS as life insurance. Now, I know some of you are like, you're trying to write all this down. Stop writing. None of what I just said matters for you, but it's important that you understand that because the term insurance rider that we put on here is very inexpensive in most cases, which reduces our compensation and our commission because we're paid a compensation on the premium, not on the death benefit. And then you can see here, this $380,000, that's the whole life insurance. So we didn't buy 1.3 million worth of whole life. We only bought, it's actually less than this, but less than 380,000 in whole life. The rest was a term rider, which we then dropped in the 7th year. This is how we reduce our compensation and our commission. And we can reduce our commission quite a bit, up to 90%, if it fits. Now, in this particular design, we would not be able to reduce our compensation by 90% because of the threshold that the client wants to put 111 in the first year and 11,000. So how we built this is 50-50. It's a 50-50 blend of whole life base and paid up additions. Again, not trying to kind of have you explain this, but this policy would reduce our compensation about high 60, low 70%. That's how much our commission would be reduced over just buying a regular whole life. But here, now that you understand all of that, let's get to the fun stuff because you're thinking that's boring. Let's just talk about how much money do you actually have to use? That's all that matters, right? Well, if you put 111,000 in design, you have 91.74% of your money to use immediately. Exactly 101,828 in the first year. Matter of fact, you could take some of this money out immediately in the first 30 days. Now, in the first 30 days, you would not have been paid the annual dividend yet. So we would come over here and we'd look at this number. That's about how much you'd have available, about 98,800, somewhere in that range in the first 30 days. But if we waited to the end of the year when the dividend paid, you can see this is how much we'd have because, well, we got paid a dividend and we had 12 months worth of interest accruing and compounding. Now, here's the cool part, okay? Not only in the first year do we have 91%. Now, I know it's not 100, but you know what? We got a $1.3 million death benefit to protect our family in case we died, okay? That's important and that has a cost, which you're seeing right here. But now the second year, this is the magic of compounding interest. The second year, you put $11,000 in, and you can take $11,729 out, which means you can take 106.63% of your premium deposit out of the policy in the second year. So if you really think about it, that's like making 6.63%. And the numbers are right here. This is just mathematics. So now let's talk about how cool this would be to use this product or this process, which I showed you earlier, to buy a piece of real estate. If here we took out $100,000, okay, we just took a $100,000 loan from the insurance company to buy that piece of real estate. So I'm just going to write it up top. Now we own this piece of real estate. And we did that by taking the money out of the policy. How much money do you think we'd have in the policy earning interest and dividends? We started with 101,828 in the first year, but we took 100 out. If any of you are watching thinking, wait, you said that none of the money comes out of our account, we're using the insurance company's money, you're right. You still have 101,828 earning guaranteed interest plus dividends, even though you took 100 out. But there's a catch. The insurance company doesn't just give you $100,000 for free, they charge you interest. Right now, let's just say that that interest rate is 5.24%, because that's one of the insurance companies we use. 5.24 is what they would charge you. Simple interest, and I know all of you are part of the fantastic crew here, so you understand the difference between simple interest and amortized interest or compounding interest. So you understand simple interest is usually the way to go. So 5.24 simple, but remember, how much was your money growing at? Well, the second year, your money you put in grew at 6.63. So if this were the second year, we would take 6.63 minus the 5.24% out. That's what they charge you. That's what you're earning. Okay. How much would you make? Well, if you subtract the two, you make the spread, just like a bank. But here's the better part. Now, I know that that's not a huge number, and some of you are like, well, that's not even worth it. Why would I do that? Because I lost money in the first year. I didn't recoup it. But then you see here, the third year, how much did we make? Well, we put 11,000 in the third year. We can take 12 out. The fourth year, you can take 13 out when you put 11 in. But let's come down here to the seventh year. This is where we dropped that term insurance. I want you to take note here. The premium deposit is no longer 11. It's only 92.05. That's how much money you could put in, because we no longer have to pay for that term rider. So therefore, the amount we're putting in drops to 9,205. How much can we take out? 12,940. Now, let's just change gears and let's just imagine you walk into your traditional bank. You put $9,205 in your traditional bank. You go back to your traditional bank, I don't know, a couple months later, and your traditional bank shows a balance of $12,940. You take that 12,000 out. You go home with a calculator and a piece of paper and you do some math. You would find that your money, your 9,205, would have had to have earned 78.36% interest that year to earn 12,940. And then it even gets better, because down here in the 10th year, something else happens. We drop the paid up additions. So now the max amount you can put into the policy is $5,500, but how much can you take out? $15,000. That is, well, 175.22% by the math. And you're starting to see how this works? You see, when we just look at it in the first year or 2 years, it's not real exciting. It's actually not at all. And I tell people this all the time. I said, hey, would you be willing to give up some earnings or lose a little bit of money even for 2 years or 3 years if for the rest of your life you would make money? Would you give up interest and lose a little bit for 3 years so that for the rest of your life, there is never a day that you don't make more the next day than you don't have more the next day than you had the day before, and that every single year your numbers would do what I'm showing you here? You put money in, you take out more than you did the year before. Every year. It's like clockwork. And some of you are looking 17 to 15, but remember, we're putting less in. We go from 9,200 to 5,500 going in. So now just imagine if you took money out to buy real estate, but your money continued to earn for you every single year. Would any of you care that the insurance company's charging you 5.24% when this is what you're making every year thereafter? I've never had a client be upset that they lost money for a couple of years, but got a death benefit. So it's not like you're just losing money for nothing. You're getting a death benefit to protect your family. That's why you're losing money in those early years. But because of the mathematics behind compounding interest, that's short-lived. And in every single policy we design, your outcome will be this. Every year, you'll have more than you had the year before. So no matter whether you're buying your own property or house hacking or buying a rental or even doing private lending, which I'm going to show you in just a second. If you were doing private lending on privatemoneyclub.com, like all of it's going to be the same. This is the better source for you to keep your wealth, because you can earn on your money and still use your money to go make money a second time. I always tell people this. I always tell people, listen, this is the only way you will be able to make money twice on your dollars. In other words, most people know how to make money once on their dollars. They take a dollar, they invest it, they make money one time. Because when you invest that money, it has to come out of the original source where it was earning so that it can earn for you in this new investment. Here, your money earns in the policy uninterrupted, and then you take it out and you use it again to make money. So I'm going to put a pin in that. I'm going to come over to Christy because she's drawing some really cool stuff on the board, and that's what she always does. And then I'm going to kind of just show you how this would look if you were to use this system to lend money. Christy, go ahead.
So while you've been talking, you mentioned this in a video prior that the insurance company is charging interest based on simple interest. And I did not realize that until a week ago. So when you run the numbers, and let's say that we have $100,000 mortgage at 7%, and 100,000 isn't, it's not even happening right now, but let's just imagine. So based on your numbers with the 5.24% that the insurance company is going to be charging, that you took off that amount that you did to use for your home, okay, the 100,000. The mortgage at 7% is $6,960 in interest per year. Okay, now that's on the amortization schedule. Over here, this is your 5.24% interest that the insurance company is going to be charging you by taking that 100,000 out of your account. So do you see the difference in interest just because you took it from this 7% amortization schedule to a simple interest 5.24%, right? Well, let's look at year 2. Now, the thing is, Chris, that I've not included is you're gaining at compound interest in your infinite banking policy that you're using, right? So
Right.
These numbers are without including what you made, which you said was, I think, 6.23% in that first year. That's not included in these numbers at all. The second year at 6840, that's going to be your interest charges on the mortgage, the amortization schedule at 7%. But look here, just because you have gained money, or just because you've gained compound interest on your amount that's sitting in your policy, this interest charge now is about $4,538 a year. I mean, we're not even talking about the monies that you're gaining in interest or the monies that you're paying back to your policy maybe during this process. This is just how it's working down your interest charges on its own by what you're gaining in the policy. Am I seeing that correctly?
No, you absolutely are. And not only that, you kind of alluded to one other thing that's important is remember with the infinite banking concept, what we're literally taking back the banking function. So we're still making a mortgage payment on that property, but we're not making a mortgage payment to XYZ Bank. We're making a mortgage payment back to our policy, which means every time you make, imagine this, folks, if you made a mortgage payment, which I know many of you do, you don't get to use that money that you paid to the bank for your mortgage the next day, do you? But you see, when you're the bank and you do exactly what we just showed you, every mortgage payment you make back to your policy is money that's in your policy and can be used the next day. But when you're making that mortgage payment, you're paying down the loan to the insurance company. Here's where simple interest is really cool. And just like a line of credit, every time you make a payment toward your loan on your policy, we'll call it a line of credit because it's the same thing, you're reducing the interest you're paying to the insurance company by sheer mathematics, because every payment reduces the balance, which means that the insurance company and simple interest is charging you interest on a lower balance every single month. So if we figure that out, the APR, which is what it would be called, every year goes down while your money that's in your policy, I showed you, goes up. One is going up, your money. One is going down, the balance on the loan. So you can see that spread I was talking about just gets bigger and bigger and bigger and bigger. And it's not because what I teach is so wonderful. It's just because mathematics is wonderful when you understand how it works and how you can apply it to money.
So I went ahead and looked up. Now I'm using Carl's mortgage calculator. I'm not pulling these numbers out of the air. The payment would be about $671 on the 100,000 for 7%. So if you're paying that back into this policy, Oh my goodness, you're literally, I mean, the amortization schedule, it's not going to change. You're going to pay $671 per month. You're going to pay this interest in the year. This doesn't change. You're in a schedule.
Mhm.
Over here, this changes.
Yep.
Every payment you make, your interest is less and less. I'm sorry, I'll never teach anything again to do with, because this is the game changer. This is how you can buy your properties on very, very little interest. It's amazing. Thank you. Thank you so much for bringing this to light, even for myself.
I love that you did the math there. And the other thing too that you also said is people, when they do this, when they become their own bank, they literally have the decision to either continue with that level payment of 671, which pays that simple interest loan down faster, or they could literally pay less every single month, because if they were just paying the interest, they could be paying a little bit less every month. So you're in control of your money, and you're in control of how fast you want to pay the loan back. But the loan is nothing more than the insurance company advancing part of your debt benefit, which is very different than a loan to a bank that if you don't pay them, they come and foreclose on your house. You see, when you're the bank, no one's ever coming to foreclose on the bank. If you get yourself in a little tough bind financially, you can't make a couple mortgage payments, go to the nearest mirror, look into the mirror, you're going to be staring at yourself, and ask this question. Hey, banker, things have been rough. I need to ask a favor. Can I just take a couple months off of the mortgage payment just to get back on my feet? I know in a couple months I'll be back where I am and I can resume those payments. What do you say, banker? And the banker looks back at you in the reflection in your mirror and says, sure, you're the bank. You set the rules. That's exactly the difference. You can't call the bank and be like, hey, bank, I'm having a rough financial time. I can't make my mortgage payment. You think you can call off the wolves from the foreclosure department and tell them, listen, just buy me a couple months? Heck no. They're going to say, sorry, there's nothing we can do for you until the government steps in and, helps you. But they're not going to do that until it's too late. That's the difference. You got to be in control of your money in order to be able to have those kind of conversations with yourself.
I swear, you make me laugh. That was hilarious. So I can't be serious when you're doing stuff like that. But you're right. But what do? They'll let you set up, a payment or two, right? But what do they get when they even set that up on the back end? They're still charging the interest. You're never out of the interest. So,
or they'll reset the mortgage or do like that moratorium stuff that they did back, in 2008, and they just literally restart the amortization schedule. Yes, it reduces your monthly payment. You're like, oh, phew, now I can make that payment. You just reset the interest amortization, which means now the bank is getting all that interest up front. Again, it's a win for the bank, a lose for you, but that's just always the way it's going to be. The longer you stay in a position where you give up your banking functions to traditional banks, that will always be the case. You will always be benefiting the bank and not yourself. When you change the gears, and I know, folks, listen, I know some of you are thinking, yeah, but I would have had to have saved 100,000. I get it. It takes time to build wealth. For some of you, that's not going to happen right away. But for some of you, you're like, yeah, I've been saving for a house. I got this money sitting in a bank account. I could do this today. So I know I'm not hitting everybody, but just realize, I started my banking system a long time ago with $240 a month. I was broke. I was highly in debt. That was all I could save. That was then. Folks, I put hundreds of thousands of dollars into my policies now, but it didn't happen quickly. It was a little bit, a little bit, a little bit. But when you do a little bit more every single year, it's just compounding interest. You compound your wealth. That's just the way it works. So I don't want anyone that's watching this to think, oh, I can't do this because I don't have a bunch of money sitting in the bank. What do you have? What could you start with? And that's your number.
Yeah. So I deal with people every week, and the ones that are preparing for the home already have the money saved up. So you're talking to probably half of my clients that have money just sitting in a bank doing nothing, and they've got debt. That makes no sense to me whatsoever. So I just appreciate this information, because you are literally giving people a way to save wealth that I didn't know before. And I know that he's talking to many, many people of you that are out there watching this right now. This is a game changer, and this is not hard. This is not hard. This is literally about starting the process today, getting these set up. I do this myself. I'm not telling you to do something that I don't do because I think it's beautiful. And I too just really got serious about it within the last couple of years. So I've lost a lot of time, but you know what? My children haven't because they're young, they're in their 20s. And they're going to be ready for this. So I'm excited. Thank you so much for sharing that.
You're welcome. And I know we're a little over time, but can I just show someone, something I want to show your audience one more thing that's really fun, because there's got to be someone in your audience. It's like, I've already got my house. I really don't, want to buy more real estate. I don't have the appetite for tenants and termites and toilets. I just don't want to do that. But what else can you do in real estate? I want to show them lending.
Do it.
So this is what banks do every single day. So I didn't, again, come up with this. This is what banks have done for hundreds and hundreds of years. They lend money. So let's use that same scenario just because we had that math. Actually, it was 111, sorry. You have 111,000 in the policy, but you don't want to buy real estate. What you want to do is you want to lend that money. And there's a platform called privatemoneyclub.com where there's tons of deals that you could lend on. But let's just pretend that over here, you find a borrower that you do your due diligence on, and you make sure that they're a good borrower, and you go through all that. And they've got a deal on Private Money Club that's willing to pay 12%. They want to borrow money for 1 year, and they're willing to give you a first lien mortgage, or first lien position on the mortgage would be the right way to say that. These are just different criteria that all of you can determine how you would want to lend. But this would be this is kind of my little box. I will lend no less than 12% interest for 1 year or less in a first lien position. So I'm kind of cheating and using mine, but you can develop yours to be whatever you want. So let's just say I got 110,000 over in this policy earning interest and dividends, but I can make 12% over here. A lot of people, what they make the mistake of doing is they say, okay, over here in my policy, let's just use 575. We'll use the low one. I'm making 5.75%. But I want to make 12%. Some people say, oh, why would I put money in the policy when I can earn more in the S&P 500? This is the same scenario. But here's the thing. You don't have to pick whether you make the money in the policy or the money in the markets or the money in this private loan, because it's this and that. Remember, you're still going to earn in the policy whether or not you take the money out. So it's not this or that, it's this and that. Big difference. Remember, now you're making money twice. So let me show you how this works. We take the loan from the insurance company, which I told you that insurance company that we're referencing charges 5.24. We take 100 grand, we deposit it in our segregated bank account. So this is just your regular bank account. And then we lend that money after we did our due diligence, worked with our attorney or title company to make sure that the mortgage and note were in place. Again, do your homework, make sure you're lending the right way. Don't just take money and just blindly give it to people. They could take your money and run away with it. You need to be in a secured position because you need to think just like a bank. Have you ever gone into a bank and like, hey, I need 100 grand for this real estate deal I'm doing? And the bank just says, sure, here's 100 grand. Nope. You got to sign a note. You got to sign a mortgage. You got to sign a personal guarantee. You had to show the bank that you had the ability to make the payments. You got to do the same thing. You got to think as if you're the bank. So you've done all that. Now your 100,000 after the mortgage is recorded goes to that borrower. That borrower starts paying you 12%, which is the interest rate they're going to pay you annually on that. So that works out to be roughly $1,000 a month, okay? So we take that $1,000 a month, we deposit it in the same bank account. We put that $100,000 loan from the policy in. But we don't stop there. We then take that $1,000 a month that is sitting in this bank account, and we set that up to be a loan repayment back to the policy. Now, you should already know this because we went over this before, but let's just test how well you're paying attention. If you put $1,000 back into the policy as a loan repayment, how much money is left in the policy the day after you deposit it? $1,000 more. So every time you take this interest from that private lending deal and put it back into the policy, your policy has another $1,000 to use. No different than the bank account. So again, you're not giving up control. And every $1,000 we're putting back in, like we talked about before, is reducing that simple interest loan to the insurance company. So now you're not really paying $524 on $100,000 like we were the first month. We're paying $524 on $99,000. The next month is $98, then $97, $96. You're making a spread. So now you're making money twice on the same dollar, and you're in full control of the money. People lend all the time, but they lend from bank accounts. And when you took 100 grand out of the bank account to lend it on PMC, you lost the earning potential in the 100 grand. You didn't lose the earning potential here. So really, this isn't complicated, folks. It's just changing one thing. That's where your money goes first, and adding one step, which is this circle that I keep drawing, because that's all it is, the infinite circle. Your money starts here, goes over here, earns for you, comes back to the original source. If you just think in the sense of a circle, that's your money. And your money just keeps flowing around it and around it and around it. And you keep getting wealthier and wealthier and wealthier.
Okay. Okay. I'm going to explode with excitement. Can you give me my representative? I'm ready to move. Amazing. That is such amazing opportunity. I know that people are going to see that with these videos and the way you're helping people to just lay this out so elementary. Like I keep using that because I feel like I stopped learning at the 4th grade. And so if anything done by those first 4 years there, I'm good. I can understand this. And I'm totally getting what you're saying. I hope everyone out there that is watching this is just as excited as I am. Chris, now you started the PMC, right? The Private Money Club. That's your business. That's awesome. What made you?
Totally free. It's totally free. Everybody can go there, create a profile just like Instagram or Facebook, and they can look at all the deals. They could be a lender or a borrower. They could raise money for their deals. So did you say, how did I come up with it?
Yeah. How did that? I mean, you're talking about genius status here. How did you do that?
It's not genius status. You know, my whole life is one compilation of blueprints of just me failing and me having problems that I have then found solutions for my own life. Like this infinite banking stuff that I just showed you. I didn't just all of a sudden start being like, oh, I'm going to teach infinite banking. I started using it. Remember I said 240. And then I watched how it changed my financial life, how it got me out of debt. And I'm like, hey, this is great. Let me introduce this to my friends. Let me introduce this to my clients. I was a financial advisor back then. So I started showing it to them, and they started having the same things. And I'm like, well, I got to start showing this to a lot of people. Now we have over 16,000 clients. And now the next evolution came as I was literally sitting there one day. During the pandemic, I had sold most all my rentals because I got sick of being a landlord in a state where they literally told the tenants, you don't have to pay rent. So I just started selling my properties off. I had 91 doors and I sold almost all of them. I think I have 7 left now today. I don't even know how many I have, but it's like 7. I sold all the rest. So now I had all this money sitting there. And instead of buying more real estate, I wanted to be the bank. I wanted to lend. So I said, all right, I got this money. I got to find good borrowers that I could lend this money to. So I did what all of you would do. I started going on social media and asking people around, hey, does anyone need any money? And everybody needs money, but they would bring me an address on a piece of paper. And I would be like, what is this? And they say, well, you said, that if we need money to bring you a deal. Well, this isn't a deal. This is an address on a piece of paper. I'm not doing your homework for you. You got to bring me the same kind of packet you would bring to a bank to borrow money on this. So I then started educating people on how to be good borrowers and lenders. The epiphany came one day. I was sitting with Stephen Nagy, and I literally grabbed a piece of paper. And let me kind of just clear this because I got to show you this. I grabbed a piece of paper, and here's all I did. I drew a circle. And somehow I had come to this realization that in the world, there are only 2 types of people. Think of a coin. A coin has 2 sides, but it actually has 3. So on one side of the coin were people like me, people that had money, but we all have a problem. And that problem is we want to make more money. So then I said, all right, that's one side of the coin. Flip the coin and lands on the other side is all the rest of the people. The rest of the people are the people like I used to be. These are people who need money to make money. So they can't make money unless they get money for whatever investment or project they have. So now I had the 2 sides of the coin, and I'm sitting there and I'm like, you know what? I had a quarter and I looked at the edge of the quarter and I said, this is not a 2-sided coin. This is a 3-sided coin because the edge around, the one that has all the ridges, that's the connection. That's where the heads and the tails came together. And I said, you know what? The connection is right in the middle with community. I said, all I need to do is build a community of people with money that meet people that need money. And just like a dating site, these two people will come together in the community, and these people with money will lend money to people that need money. And people that need money will make interest payments back to people that have money. Each of them solving one another's problems without a traditional bank having to be in the middle, messing the whole thing up. That's how it all came to me. True story. That's exactly how I did it.
That is absolutely genius. Like I said, beautiful. I am going to get with one of your team members like today, and I'm going to start working because I have deals too that I want to see, you know, what kind of lender is out there that's interested in working with things here. I mean, what a great, wonderful platform that people can come there and just, you know, show what they have to offer. And let's see if, you know, if somebody's going to be there able to help them. And on the other hand, I have a lot of people that have a lot of money. So it's like, put them in there and grow your money. I mean, it's absolutely genius.
Hey, are you ready to take control of your financial future? Welcome to Private Money Club. Private Money Club is the ultimate online platform connecting real estate entrepreneurs with private money lenders just like you. Whether you're looking to fund your next deal or lend money to grow your wealth, Private Money Club is your go-to resource. You can post deals, find funding, connect with other like-minded professionals. It's just a community. It's a community that you need to plug into. If you're new to the game, no problem. Our Learn platform and our weekly coaching webinars and our on-demand resources are here to guide you every step of the way. Join a thriving network of real estate experts who are already making an impact, and they're waiting to partner with you. So Private Money Club gives you the tools, the training, the connections, and everything you need to achieve your financial goals. So why don't you start now? You can either do it with a free membership, or you could upgrade to the paid Premier membership for exclusive perks, and there are a lot of them. Because money talks, and at Private Money Club, we speak its language. So join today by going to privatemoneyclub.com. We'll see you inside.